Good morning, traders. Welcome to Bulls, Bears, and the Bell. This is your morning briefing.
And futures are signaling a notably lower open today. It's being driven hard by that persistent fixed income volatility and what really looks like an aggressive defensive de-risking move.
So everyone is getting defensive.
Everyone, all eyes, and frankly all capital, seem to be pre-positioning ahead of the single most critical earnings report of the quarter.
Which is NVIDIA reporting after the bell tonight.
That's the one.
So today's session feels less about broad macro trends and much more about navigating these extremes.
Yeah.
You've got this structural narrowness in the underlying market, and then just the immense weight of tonight's event risk.
Right.
Our mission this morning is clear. We need to unpack that global sentiment, understand the extreme and frankly alarming divergence in market internals.
And we absolutely need to identify the key technical battlegrounds for the index.
Exactly, and outline the must-watch economic and earnings catalysts. This is the ultimate balancing act for risk.
It really is.
Okay, let's unpack this with a look at the overnight action. How are global markets setting the tone for the U.S. Open?
Well, what's fascinating here is the consistent and widespread defensive nature of the shift.
It's everywhere.
It is. Asia was generally lower, but the fear was focused specifically on tech valuations. We saw the Nikkei 225 fall for the fourth consecutive day, down about 0.30%.
And that's just a continuation of this fatigue we've seen in big tech here. It's spreading.
It seems to be going global, yes. Now, we did see some small pockets of resilience.
Like in Shanghai.
Exactly. The Shanghai Composite was a modest outperformer, posting a slight gain of, 0.18%? Probably some localized policy support there.
Okay, so a little divergence. What about Europe?
In Europe, markets were mixed and certainly very cautious. The FTSE 100 did manage to post a modest gain of 0.10%.
That's being tied to their inflation print, right?
Directly to it. A cooling UK inflation reading gave them a little breathing room. A glimmer of hope, maybe, for the Bank of England.
But when we look at our own futures, they're clearly confirming that overall risk-off mood.
Oh, absolutely. The S&P 500 futures, ES, and the Nasdaq 100 NQ both lower by about 0.40%.
And what's really telling, I think, is the Dow Jones futures, the YM, is actually underperforming slightly, down 0.5%.
That underperformance in the Dow is such an important signal. It suggests the pullback isn't just, a few richly valued tech names.
Right. It's broader.
It's translating into broad industrial and cyclical weakness. That's skepticism over global growth. And it's not just anecdotal. It is reinforced vividly by the cross-asset rotation we're seeing.
Okay, so let's get into that. What are commodities signaling? Because gold and oil, they usually give a really unambiguous read on risk appetite.
We have a classic risk-off rotation in play. WTI crude is under pressure, down about 0.84%.
Signaling pessimism on global demand.
That's right. And at the same time, gold, XAUSD, is seeing a strong flight to safety bid. It's rising over 1.24%.
So when oil drops because of growth fears and gold rallies as a panic hedge,
the market is confirming severe anxiety. It's not subtle.
And crucially, the bond market isn't providing any stability. In fact, it's actively contributing to the stress.
Not at all. Fixed income remains the persistent headwind. We look at the movie index, which measures expected volatility in the bond market.
And that index is still high.
It remains highly elevated at 83.18.
83.18. For our listeners, why should that specific number matter? It's just an index level.
That reading is important because it's near the highest levels we saw during the intense banking stress earlier this year. It confirms the underlying cost of insuring against risk in the debt market is structurally high.
So when bond vol is this sticky, it just makes sustained equity rallies fundamentally harder to achieve.
It really does. Traders need that low volatility anchor, and bonds just aren't providing it right now.
But wait, if money is flooding into safety, as confirmed by that gold rally, shouldn't that be driving bond yields down?
That's the critical paradox, isn't it? The sellers in the bond market, they're driven by inflation expectations and persistent supply.
And they're overpowering the safety bid.
They're essentially overriding it. The fact that the 10-year is pinned above that 4.0% level, it's at 4.1 area right now, confirms the market is still deeply worried about the Fed's higher for longer narrative.
So until that 10-year yield breaks meaningfully lower, risk assets remain constrained.
That's the bottom line.
So persistent risk-off sentiment globally, reinforced by the bond market's unwillingness to calm down. The question now becomes, where is all that stress showing up domestically? Let's take that market internal temperature.
Right, let's look at the actual health. Now, we should acknowledge that overnight price action in the futures was, let's call it mild consolidation.
Just holding near the prior settlement.
Exactly. But if you look beneath the surface, the story is far weaker. The Russell 2000 small caps, the RTY, were notably underperforming,
Down about 0.25%.
suggesting continued weakness in domestic names. Small caps are really struggling.
And that brings us right to the narrow market trap you highlighted, which truly illustrates just how poor the underlying health of the market is.
This data is screaming divergence. I mean,
Right.
yesterday's NYSE advanced decline ratio was a staggering 4.03 to 1 decliners.
4 to 1. So for every one stock that went up, 4 went down.
That is broad-based, almost indiscriminate selling pressure across the vast majority of stocks.
That sounds broadly bearish, and yet the volume signal seems to contradict that, which is highly anomalous.
It does. The TRIN, or the ARMS index, closed extremely low at 0.56.
And a tree on that low isn't just a statistical blip.
No, it tells us that the few stocks that did advance commanded a disproportionately high share of the trading volume.
So the interpretation is clear. Most stocks sank, but the capital rushing out of those losers didn't flee the market. It just concentrated itself aggressively into a handful of mega-cap leaders.
Precisely. This is the definitive signal of a flight to size. Capital is aggressively chasing the exact same dominant liquidity names, avoiding the broad market.
And historically, that extreme narrowness precedes instability.
It does. We are dealing with a high-stress environment where the majority of equities are showing severe fragility, and it's masking the weakness behind the strength of a few heavily weighted index components.
Which leaves the broader market structurally exposed if those leaders falter.
That's the risk.
Okay, that diagnosis is vital context for the technical picture. So let's look at the key levels for the S&P 500 futures, ES. Given the narrowness and the event risk, where is the pivotal battleground?
Well, the structural thesis remains, fundamentally bullish in the long term, supported by that 4.1% GDP estimate. But tactically,
Uncoiled.
exactly, we're ready to break. The primary resistance, the key tactical pivot we must breach to confirm sustained risk on, is 6,850.
6850.
A sustained breach and hold above that level clears the path toward the multi-week breakout target of 6,925. That is the bull's key battleground.
And to the downside, where does the whole structural bullish thesis break down?
The critical structural support is the November low at 6,631. A break and close below that level invalidates the primary bullish structure entirely.
And suggests a deeper correction is underway.
Yes, likely heading toward the 50-day moving average. And given that 4 to 1 negative breadth, the downside risk here is material.
Stepping away from the index for a second, let's look at some isolated single stock movers pre-market.
Sure. We've seen some high-volume, isolated moves. On the upside, NanoX Imaging, NNOX, is sharply higher, up over 16%.
Wow. What's the driver?
A major AI partnership announcement and a bunch of analyst upgrades. It confirms that highly specialized AI exposure is still being rewarded aggressively.
Okay, and anything else on the upside?
We have hypothetical tech name HYPE up 4.5% following an upgrade to outperform.
And conversely, what's signaling specific weakness?
SanDisk Corp, SNDK, is down almost 8% on elevated volume.
Yeah, that's just a classic negative reaction to forward guidance.
Either that or a missed earnings estimate. It's contributing to the overall cautious tone. Money is moving surgically, not broadly.
Okay, here's what is on the deck for today. The event risks that will inject the most volatility.
Right. We've got pre-market earnings, after-hours earnings, and critical economic data.
Starting with pre-market earnings, we have Lowe's, ticker L, low W.
This is a huge one. This home improvement retailer is so much more than just retail. It's a critical, real-time check on the U.S. consumer and the housing sector.
The consensus is looking for an EPS around $2.97 and revenue near $20.84 billion. What should traders be focused on?
You have to look beyond the headlines. Scrutinize comparable store sales or comp sales. That's true organic demand.
But the real story is in pro customer segment, right?
That's where the insight is. The pro segment tells you how construction and renovation businesses are performing. A good read there could stabilize the whole consumer discretionary sector. A weak read confirms high rates are biting.
And then we get to the main event, the single most critical piece of corporate news for the entire market. NVIDIA. After hours.
The market is absolutely positioned for perfection here. The expectations are just immense.
Consensus revenue pegged near $54.9 billion.
But what truly underscores the magnitude here is the implied volatility in the options market. It's suggesting a massive 7.69% single-day move.
In either direction. And that exposure means $320 billion in market valuation is riding on this report.
Which is larger than the market cap of many S&P 500 components. It's why the entire market is just waiting.
So what are the key focus areas? Data center revenue, as always.
Yes, but the street is entirely focused on the future roadmap. Specifically, commentary on the ramp-up of their newest technology, the Blackwell B200 platform.
The next generation of AI chips.
Exactly. We know the demand is there, the risk is the supply.
So the primary risk isn't a third-quarter miss, but conservative guidance on that Blackwell ramp-up speed.
That's it, precisely. The bulls need a flawless execution narrative and guidance that confirms they can scale production of the B200. Anything short of that.
Any hint of a delay.
And that $320 billion in implied risk will materialize aggressively to the downside, and it will pull the rest of the NQ down with it.
Okay, flipping to economic data, two major releases. First up, Eurozone HICP final at 4 a.m. Eastern.
High volatility for European markets and the euro here. The core HICP year-over-year consensus is plus 2.04%.
And an upward surprise, say 2.2% or higher, would signal sticky inflation.
It would immediately prompt a sharp repricing of ECB rate cut expectations, pushing those cuts further into the future.
Causing a rally in the euro and potential selling pressure on their indices.
You got it.
Then later at 8:30 a.m. Eastern, we get U.S. housing starts and permits.
Medium-high volatility here. Consensus is 1.320 million starts. This is a key bellwether for U.S. economic momentum.
So 1.3 million is the expectation. But if we see anything above, say, 1.4 million, what's the implication for the Fed narrative?
A major upside beat like that implies unexpected economic resilience. It suggests the economy is shrugging off high rates, reinforcing that higher for longer story.
Which means a stronger dollar, higher yields.
Right. And conversely, a big miss would signal decelerating growth and probably prompt a rotation into defensive sectors.
It is a phenomenal balancing act for traders today. You've got the structural thesis, which is still bullish, supported by that 4.1% GDP estimate. But the immediate day is purely about navigating this extreme internal narrowness.
That scary flight to size and then pre-positioning for tonight's binary event. We are positioned right against that key tactical resistance at 6,850.
So the path of least resistance feels lower until we get clarity tonight.
I think so, given that dominant 4-to-1 negative breadth. Traders really need to treat 6,850 as the pivot. A sustained break above confirms risk on. A rejection there.
Combined with a break below the 6,631 low.
Confirms a downside risk is materializing.
So the ultimate question for the market is whether these handful of mega cap leaders, which are the only thing holding up the index, can actually withstand the gravity of a majority of stocks collapsing underneath them.
Can the market sustain being 4-to-1 bearish if NVIDIA fails to deliver a flawless, accelerated ramp-up forecast tonight? That is the tension that defines this session.
And that's the bell. Thanks for listening to Bulls, Bears, and the Bell. Follow us to stay one step ahead of the market.